Mona, a lot of the strength of the economy is riding on consumer spending. So where do you see consumer sentiment right now? How strong is the consumer?
Yeah, look, Greg, it's really a tale of two data sets. Consumer sentiment data on one hand has been weakening. We're seeing that in the Michigan sentiment surveys and other consumer sentiment surveys that are showing a softer set of data. But if we look at the hard data, things like earnings growth, things like consumption, all of those are holding up actually rather nicely. So consumption in the first quarter, 1.8%, very nice. It's looking on track to even exceed that in the second quarter. Earnings growth, Q1, 13% year-on-year earnings growth. We know corporate earnings underpin stocks and the economy, and that's holding up well.
And what about inflation? Because we're not just watching the consumer, we're also watching how inflation is weighing on the consumer. Yeah. And it doesn't seem like the Fed's going to be doing much anytime soon.
Yeah, it's a great call out. Look, inflation had been front and center over the last several years. Now, look, the last CPI data report we saw, 2.3%. So we are actually seeing inflation contained, at least through the first few months of the year. The impact of the tariffs have not yet showed up on consumer prices. That could change going forward, of course, as tariffs kick in more effectively, as companies work down their inventories. But for now, inflation is contained. And in fact, we think the Fed is in wait and see mode. What happens with the tariffs? What happens on both inflation and the labor market? But we do think the bias of the Fed is to cut rates and probably 1 to 2 times by year end.
And before we get into the areas of opportunity that you want to invest in, can you discuss a little bit further the impact of the tariffs? Because they're not weighing on the indexes right now. That could change with a tweet.
Yeah, absolutely. Look, we all know what happened in the first few months of the year. Tariff uncertainty was the name of the game. The S&P dropped 20%, but since then we've seen a 20% recovery in the S&P, and that's because the administration walked back tariffs. That's also because the hard data, as we talked about, held in better than expected. We do think tariffs are on pace to go from probably 2% to the start of the year to probably 10% plus. That does mean that prices may marginally move higher. Economic growth may soften, but notably, we don't yet see a recession on the horizon, or at least it's not a base case for us. We think we soften from a 2.5% growth rate to maybe sub 2%. But the impact of the tariffs, we think for now can be manageable, and markets are looking beyond that as well.
Okay, we figured out the economy. With all that in mind, how are you investing at Edward Jones? Let's start with equities, and then we'll work way over to bonds.
Yeah, look, we think we remain overweight equities versus fixed income. Within equities, we continue to like large cap equities and we continue to like mid cap equities. Both of those we think offer diversification. We think growth and value sectors make sense here. Keep in mind what we saw in the first few months of the year, diversified portfolios held in better than concentrated portfolios. So areas like US, international, bonds, if you had a combination of all of these, you actually held in quite nicely. We think that combination works well in the year ahead.
And what are your thoughts on the bond market? Because we keep hearing that people get afraid when you see the 30-year at 5% and the 10-year at 4.5%. And they really haven't moved much recently, but you get a sharp move that could spook people.
Yeah, it's a good point. All eyes are on the bond market this year. We know deficits are rising and debt levels may be moving higher. All that being said, we got a Moody's downgrade. We got auctions that were mixed, and we're still seeing the 10-year under 4.5%. So we do think the TINA effect, there is no alternative to a U.S. Treasury bond, remains in place. When you look globally, U.S. Treasuries are still the most liquid, most regulated market in the world. We think there's still a lot of good demand there.
And then finally, let's put the whole portfolio together. We've talked about stocks, we've talked about bonds. What about alternatives? What about Bitcoin? What about gold, which has been rising? Even gold's little brother, silver. So can you put it all together?
Yeah, look, we think investors can do a lot with just equities and bonds. We actually think, look at the 20% rise you just got in equities, look at a 10-year offering a 4.5% yield. The combination of those two alone across different asset classes or subsectors within equities and bonds offer a nice mix. Now, do we see alternatives as part of your portfolio, especially if you're a high net worth investor and you have some liquidity? Absolutely could be a nice diversification tool. But we think those three alone offer a really nice set of investments for long-term investors.
All right. Well, thanks for coming on and talking about it.
Thank you, Greg. Appreciate that.